Good morning and welcome to this Wednesday, July 12th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Just to mention Tyler, I'm unable to share my video, so not sure why, but it's just saying host won't allow me to share. So check that out. If you have a solution, let me know. Otherwise,
You should be good now.
Okay, hold on one sec. There we go. Okay. Good morning, everybody. Good to be here with you again. I do want to mention a couple things before we get started today. We are having a live trading session starting at 10 o'clock this morning. So 1 hour from now, all of our members at Earnings Beats are invited. So even trial members are invited. Once you sign into your into our website, there will be a link to the room that you will be able to join us there. So make sure that you check that out today. If you can't make it live, I understand people work, you got things to do during the day, but if you can't make it live, we'll make the recording available. You can go back in and check it out. It's certainly not a guarantee of how you make money, but I'll kind of walk you through some of the things that I do preparing during the day. I mean, normally I don't do a lot of trading in the morning unless the market is, moving in my favor. So if I'm looking to go long, a lot of times I like to see pullbacks. I like to see stocks that are getting back closer to key support. You can have like from our strong AD chart list, many of these stocks are on there because they tend to finish the day much stronger than they begin. So that's one area that I like to look at in the morning, especially for short term, even like a day trade. Stocks are getting hit, maybe by 10, 11 o'clock in the morning that tend to finish strong, that have very strong AD lines. That would be one thing that we would, certainly be focused on from a shorter term perspective. But then there are a lot of swing trades that we like to put on. I think the market just keeps getting healthier and healthier by the day. So I think all of that leads to some great trading opportunities for us as we move forward. I think as far as, if you just want to keep your risk somewhat to a minimum, you can't eliminate risk. Anytime you invest, you can lose money. But if you want to try to avoid the individual stocks, we have an ETF portfolio that's doing well. And I've been talking a lot recently about certain areas of the market that I really favor, especially the small caps, which broke out yesterday, finally above key resistance. And that group is really moving this morning again on the heels of a lesser or lower than expected June CPI report. I'm going to talk about all that in just a minute. In fact, let me go ahead and get things started here. Okay, I'm going to go ahead and start with the recap from yesterday. We had the Dow Jones Industrial Average finish up 317 points, S&P 500 up almost 30, the NASDAQ up 73, mid caps 29, and small caps 11. Looking at it from a percentage basis, mid caps were your leader yesterday. Small caps just a little bit behind, up almost 1% on small caps, a little bit more than that on the mid caps. And transports up another 1.4% yesterday. This area of the market is just exploding. And you can say all you want about the market and you think it might go down, blah, blah, blah. But I'm telling you, when you see the transports moving like this to the upside, they generally do this for only one reason, because either we're seeing the market strengthen or the economy strengthen, or the stock market's convinced it's going to. Because the market's always looking forward. It's not looking at what happened 3 months ago or 6 months ago. The market's always looking forward. And so to see the transports going up like this, and I had pointed this out when we went through 14,500, that was a kind of the first telltale sign that transports were finally going to get their feet under them and start moving to the upside. We had consolidated, you can see, for a few months beneath that 14.5 area, just couldn't quite get that breakout. Well, we got that breakout, and it's been almost a month ago, and it has been a huge rally since. Transportation stocks, which generally don't move that fast, are up 10% in the last month. 10% in the last 30 days. Now, again, you can call it what you want. For me, it is a no-brainer. When I see transports running like this, history tells me the S&P 500 is coming along for the ride. And that's what we've been seeing. The S&P 500 up again yesterday. Today, with the CPI report out and below expectations, that is giving the U.S. equity markets a great opportunity here. We're seeing some nice movement to the upside. Of course, it's not, we haven't gotten to the open yet, but let me give you those futures. So as of about 10 minutes ago, the Dow futures were up about 0.5%. The S&P 500 futures up almost 2/3%. The NASDAQ futures up close to 1%, about close to 0.9%. Crude oil prices up 60 cents. They're now above $75 a barrel. And the U.S. 10-year Treasury yield, after gapping down and leaving that island cluster reversal that I talked about, down another 7.5 basis points this morning. Of course, it was kind of hard to get excited about the yields going down when you had such a big inflation report this morning. I get that. And tomorrow we have another one. We have the June PPI coming out tomorrow morning, Thursday morning. But as far as I'm concerned, the consumer price index is much more important than producer price, because a lot of times you can get inflation at the producer level and they don't pass it along. They decide to eat the costs. And so it doesn't always translate into inflation at the consumer level. And that's the level that we're really concerned about. So I think all things are go right now in the market. We definitely have already made a big move. As I've been saying, we had some short-term warning signs out there. I mean, anytime that you see the equity only put call ratio, 5-day moving average starting to move to recent lows, that's always a little bit of a concern, because that's telling us that retail traders are getting very bullish in the near term. And the equity only put call ratio, that is a sentiment indicator that is generally viewed as a contrarian indicator. So that's something that we need to continue to watch. Also, we have negative divergences that we've talked about. Look at these daily charts right here up on your screen. The S&P 500 moving to new highs, lower PPO. The NASDAQ 100, not quite up there to the new high just yet, but that PPO has been very weak. With today's move and likely gap up, we're going to probably have what could be a negative divergence by today's close across a couple of our key indices. Meanwhile, mid caps, you can see that PPO starting to turn up just as we made a breakout yesterday. Small caps just making a breakout, starting to turn back up again with its PPO. I think these are two areas where we're benefiting right now from some of the rotation. And this rotation in the market is bullish. Looking at the sectors, energy up 2%, 2.2%. Communication services, 1.75%. Utilities, 1.25%. Looking at a couple of the industry groups, and I want to try and take a look at more of those later in this show. But toys up 65 points. That's 6.6% yesterday. That was a huge move in the toy group. And this is a group that really struggled in 2022, but has picked up. And with yesterday's move, really starting to look much, much better. The U.S. Oil Equipment and Services Index, talked about the big moves recently. Well, yesterday was another one. We've broken that downtrend. All of a sudden, we got a lot of the energy groups coming back, with crude oil prices jumping up, getting back up above the XLE, now back up above $82. Seems like energy is back on track again. But this is a group that personally I have problems trading, because just when things get going, they tend to pull back again. Then just when you think things are bad in energy, then they take back off again. I personally have problems using technicals on the energy and doing it consistently successful, or consistent. I don't know, just being consistent. And so we'll see where that goes. But at least from a technical perspective, that area of the market performing much better. Then check out the travel and tourism index, up over 3% yesterday, continuing its move. Notice we pulled back at that 20-day moving average, bounced right off of it. When you are trending higher, that's one of my favorite indicators, that 20-day moving average. I could trade off of that, just having that with price action. Now, obviously, I like to use a lot more, but if I'm trading individual stocks or even ETFs, I love those falling falling prices down to that rising 20-day EMA. All right, let's keep moving on. I did want to just mention that later today, we will also have the beige book out. And that, if you're not familiar with the beige book, you have 12 Federal Reserve districts, and before each meeting, there are 8 meetings a year. And before each meeting, one of those Federal Reserve districts will basically report on economic conditions of all 12 of the districts. And so that report will be released this afternoon. And generally, this report comes out about 2 weeks or so before the next Fed meeting. And we do have the Fed meeting coming up in a couple of weeks. The Fed has said they're going to raise a 1/4 point. I don't know if today's inflation news will change that at all. I suspect it probably won't. But I can tell you that as inflation keeps coming down, there's a really good chance that the Fed is going to stop. And they've even mentioned that, hey, this is it. This month, maybe next month, and then they're probably going to rein it in. I'm not convinced we'll get a second one. Maybe we will. I don't know why they're raising, to be honest. I see inflation continuing to roll over. I think that was their goal in raising rates, was to bring inflation under control, make sure that did not get away from them. Of course, it already had to some degree, which is one of the reasons why we had the 2022 cyclical bear market in the first place. But they did, go through a series of very aggressive rate hikes and have brought or helped to bring inflation down under control. I think I saw on the core CPI, the annual rate announced this morning was back below 5%. It was expected to come in at 5%. It came in at 4.8. So I don't see an inflation problem. And when you don't have inflation, any good economic news is great, because that means we're probably going to have higher growth. We're probably going to have higher profits on S&P 500 companies. And if rates are no longer going higher and there's no inflation problem, many times rates will start to drift lower. And if you get higher profits with lower rates, it's nirvana for US equities. So that's what we've been calling for. It's been a little slow on the interest rate side in terms of turning around, but I think the market is forecasting strong growth ahead. I don't know, if you're using technical analysis to help you predict the future, which is really what it's all about. I don't know how much good technical analysis does to say, hey, we're up 30 or 40% this year. Or, last year, hey, in June, we're down 27%. I mean, that's great, but if you didn't do anything to prepare for it, I'm not sure that really helps you a whole lot. So I use technical analysis to manage risk. Really, it's a great trend following strategy, just using technical analysis when we're moving higher or moving lower, trying to find areas. If we're moving lower, find areas where you can short, or maybe move to cash, or maybe just sit in cash. And then during uptrends like the one we've been in, I think technical analysis is a great mechanism to continually monitor your risk to the downside. And so that's what we do at Earnings Beats. You've heard me talk a lot. Usually, most bull markets, I'm talking about individual stocks. This one, I've been talking more about ETFs, and then also the leveraged ETFs. And I've been doing so because it wasn't really until we got through 4,300 on the S&P 500 that we had confirmation in terms of price action that the bottom was in. So really haven't had a whole lot of opportunity to get into individual stocks, but I do think that at this point going forward, I believe individual stocks are certainly starting to make a lot more sense. Okay, let's move on. I want to show you just quickly, talking technically, a few of these indexes. So the S&P 500 moving back up close to the high, and we can take a quick look. Let's you click on symbol summary, and then you go through the ETFs that track the major indices. So the diamonds for the Dow, you can see right now up 0.7%. That gives you real time. So if you're using futures and it's from a site where it's delayed, a lot of times going into stock charts, just pulling up these ETFs pre-market makes a lot of sense to me. So right now, diamonds up, or the Dow, roughly 70 basis points, 0.7%. The spider up 9/9%. 91 basis points, big move on the spider. How about the QQQ? Up more than 1%, back to 372, setting a new high with the action this morning. And IWM up almost 2%. So that TNA, and I talked to members yesterday, I actually got out because I didn't want to take that additional risk going into this CPI report. So I just got out of the TNA and just moved it all into the IWM. So I was just, I'm content going up with the ETF at this point because I do think risks are elevated. At some point down the road, we'll get a pullback and it might make more sense to get into the TNA. If you're holding the TNA, what I would do, and if you really want to give it some room to the downside, just hold it as long as we continue to trade above that 20-day moving average. And maybe at some point we'll get to, we'll show a negative divergence, maybe on an hourly chart. That might be something where you look to start taking something off the table. But personally, I'm completely fine just riding the IWM, the QQQ, the spider, whatever you want. I just think the rotation favors the IWM. When I see the transports starting to lead the market, see some of the other areas maybe that have lagged for a while. I mean, we've seen the cruise lines, which were under pressure for such a long time. Airlines, same thing. We're starting to see areas that had been underperforming on a relative basis for quite a while. I would throw small caps right in that group. I think that group is now starting to make a move to the upside. I would not be surprised to see the small caps continue to outperform for a bit. But again, I'm fine with the IWM. I think the market still looks very good here. And as I've been telling members, I don't want to be out of the market. Even if it's overbought, even if they're negative divergences, get out of leverage. Because that does present some additional risk, and the market's showing us some short-term warning signs. But I would not be out of the market. I don't get out of the market when I think we're in a secular bull market advance. And I think we are renewing that secular bull market. I think the cyclical bear market, as I've said for many months now, I think that's in our rear view mirror. And I think the market's going back to all-time highs. And with today's action, I mean, when the S&P 500 gets back to 4,500, you have to realize we're only 300 points away. And we will have gone up more than 1,000 points off the bottom. 1,000 points off the bottom from 3491. When we get to 4,500, we will be 1,000 points off the bottom and only 300 points, or a little more than 300 points away from that all-time high. I believe we're going to see it this year. I've kind of been teetering between whether it happens this year or the beginning of next year, but I believe it'll probably happen sometime in the fourth quarter. Okay, let's move on. Take a look at the NASDAQ 100. I think the breakout's coming today there. IWM, we've been talking about that. There was your breakout yesterday. That's continuing. Looking up, another $3? Or, what was that? Where were we? 193.41. So up $3.61, 193.41. So that takes us all the way up somewhere in about here. And what I mentioned to members recently was getting through this 188, 189 level. I thought it would be a quick trip up to this 198 to 199 resistance where we've got our double top. We're moving there really rapidly. I could see us being there very quickly, another couple days, maybe within a week. And then we'll see. I think we're going through. I think we're going to go through that resistance. And I think the IWM, if you look at the long-term chart, everybody gets so, it's easy to have recency bias, to just look at what's been happening recently and say, oh, small caps aren't participating. We're at this horrible, blah, blah, blah. You need to have a little bit more longer term perspective. But if you look at a long-term chart on the IWM, I mean, I see nothing but an uptrend. And, if this was a daily chart on a stock and it had a big move, a few months ago, and then it went back to its 50-day moving average and it was holding on to support, we would probably not think anything of it. But when we look at this and it's a monthly chart, you have to have perspective because it's been weak for so long that it starts to wear on you, especially if you're listening to all the media headlines and how awful it is that small caps aren't participating. Remember, it was just the FANG stocks that were leading us just a couple months ago. That was horrible because the rest of the market wasn't doing well and transports weren't doing well. Well, now look at the market. This is what happens in a bull market. We get that rotation. It's not always pretty in every area, but we do get that rotation and we continue to see uptrends, including the IWM. on this monthly chart, there's no doubt in my mind this is an uptrend. I said it when we were pulling back. There's your double top, right around 160, little above 160. Where did we pull back to? 160. I mean, it was a classic broken resistance becomes support. Technical analysis 101 right there. Transports, not going to, talk too much about this. Once we got through that 14.5 area right here, we were trending down. We had a reaction high, went back down, essentially put in a double bottom, and then came back through and got through that 14.5 area. And we really haven't looked back, continuing to move up. I think the transports look great. All right, chart of the day. For those of you who are interested in seeing charts of the day, we do provide 3 of these a week at Earnings Beats, and it's a free newsletter. Comes out with our Earnings Beats Digest. If you go to our website at earningsbeats.com, you scroll down, there's the Earnings Beats Digest. Name and email address is all it takes. And from there, we get you set up, and we'll report to you Monday, Wednesday, and Friday with a different chart. 2 paragraphs and a chart. That's it. Very simple read. We focus on earnings, relative strength, candlesticks, price volume, all those types of things that are important to us. So you'll simply, hopefully, learn a lot more about trading and maybe improve your own trading results by following along to that. Later this morning, as I mentioned at the open, in about 40 minutes, going to be starting our live trading room. We've had 2 of these recently. We had all day live trading rooms, which our members absolutely loved. We actually had some really nice trades in there, which always helps. But this one will be a mini version. I'll just go through scans that we use. I'm going to pull up some stocks. We'll look at a bunch of charts. I'm also going to be talking about, you can tell I'm bullish about the market, and I've been bullish. If you've been following me, I don't waver a whole lot. Short term, I might get a little cautious, but otherwise I stick to what I see in the market, whether it's a cyclical bear market or a secular bull market, doesn't matter. What my signals tell me is what I stick with until my signals tell me something else. And so today, during this trading room, I'm going to talk about a couple of those signals that I like to follow and what it would take for me to turn bearish, because I get this question all the time. Well, you're bullish, but we still got all this bad news. What would it take for you to be bearish? Why don't you think the market's going to crash? Well, I don't. I mean, again, you look at perspective, and I think that's probably the biggest thing. If I wanted to point out one thing that separates me from a lot of other technicians or a lot of other analysts, I try to take the big picture always into account. And I think too often with technical analysis, we only look at the last 6 months, or we only look at the last year. And we try to base everything on that. I'll give you a perfect example of this. I saw, I'm trying to think where I saw it. I think it was just an article that I read, but someone was talking about the fact that interest rates going back through 4%, and I've talked about this as well. Historically, if you look back over the last year and a half, when rates have gone up, U.S. stocks have been getting hit. And about a month ago, I started talking about a character change in the market, because what most people don't realize, especially if you're just looking out over the last year, is that interest rates, when they go up, they tend to go up with the S&P 500. And, logically, when you think about it, you're like, this doesn't make any sense. Interest rates going up, that should be headwind for the market. The market should go down. But that's not the way it works. When the economy is starting to strengthen and S&P 500 companies start to produce higher and higher profits, you want to be in stocks, right? Well, as you start to go higher and higher, you actually want to be out of bonds because you want to be in stocks. So it's actually that rotation from bonds to stocks. When you see the Goldman Sachs coming out and saying, we're going to move from 60% equities to 65% equities, and we're going to move down from 25% bonds to 20% bonds, that rotation, when you are selling bonds, you're sending rates higher. And you're sending rates higher because eventually the Federal Reserve is probably going to start raising, especially if there's any concern about inflation. If the economy is heating up too much, then you'll start to see the Fed raise. But the Fed is more about short term. The 10-year Treasury yield that I like to follow is more about, it might have some influence by what the Fed's doing, but not really. it looks at a lot of things, including inflation expectations, because you want to earn a certain return. And if inflation is starting to ramp up, then you're going to want to have a higher return. So you sell bonds because of the problem with inflation eating away at your yields. And so folks will sell bonds and a lot of times move into like utilities, something that will pay higher dividends, income investors in particular. Anyway, a lot of times when the bonds are being sold and rates are going up, the stock market's going up. Look at history. Get the 10-year treasury yield out and look at it use correlation versus the S&P 500 and check it out. You'll see it's not a perfect positive correlation, but there's a lot of positive correlation in there. But anybody who's looking at just the last few, few months, maybe a year in the market, comes up with a different relationship, because they see every time that rates have been going up, the stock market goes down, and then they get biased. They have recency bias. I don't have a problem with rates going up as long as we keep it to a minimum. At some point, folks will bail from the stock market and move to bonds if rates are high enough. I think that level is probably in the 5 to 6 range on the 10-year treasury yield. So we're sitting at, under 4%. I still think historically, this is a great rate. This is still great for the economy. If we've got signs of economic conditions improving and we keep rates in the upper 3s, low 4s, even mid 4s, I have no problems with that. All right. So the chart of the day, anyway, I kind of got off on a tangent there. Chart of the day, I just wanted to mention Etsy. And the reason I wanted to mention Etsy here, making this big push to the upside, is that it's one of our top seasonal stocks. It actually was our #1 seasonal stock that we provided to members at the beginning of July. And the reason, if you go back in seasonality, Etsy went public 9 years ago. Since then, July, it has averaged going up 12% per July. 12%, that's a great annual return. And this is what Etsy has done on just a 1-month basis, average. Now, it only goes up 2/3 of the time, so it's been up 6 of the 9 years. So it's not a slam dunk guarantee, but this is the time of the year, one of the times of the year when Etsy performs really well. And I also like it because June, July, and August, these 3 months are all typically pretty strong. And when we look at that Etsy chart, you can see June, we bottomed right at the beginning of June. So you've got June, July, and August. And look at what we're doing now. July is all of a sudden gotten off to a great start. But we know that we have historical tailwinds. So if I begin to see things technically that, click and start to make me think, hey, might not be a bad opportunity, I also know that history lines up with the stock as well. Now, all of that really doesn't guarantee us anything. You can take all of that plus $5 or maybe $8 and get yourself a Big Mac value meal, because it doesn't guarantee us anything more. But, we're looking for reward to risk. We're looking for tendencies. We're looking for trying to manage our risk to the downside while trying to maximize our potential reward to the upside. And so when you see a stock like this beginning to show tactical signs, and we know that the next 45 days historically are pretty strong, then this stock could make a lot of sense, especially if maybe we pull back and test these moving averages. So anyway, I had mentioned that one. Market's about to open, but I'm going to go through these industry groups because we're going to go a little bit over because I do want everyone to check out some of these groups that are moving. Now, one of the things that we offer to our annual members at Earnings Beats is this relative strength chart list that we do. We have one for sectors and we have one for industry groups. And the way I've got this set up is if we look at, we'll edit this. And if you look 001, anything that starts with an 001 is technology, XLK. And then I've got them numbered 001 to 008 based just on the various industry groups within technology. Then we go to 002, which is discretionary stocks. 003, that's the communication services. 004, industrials. 5, financials. 6, healthcare. 7, consumer staples. 8, real estate. 9, utilities. And 10, energy. 11, materials. So they're all broken down by groups. And one of the reasons I do this is if you pull this up in summary form, you can see, if you've got it listed here, I can look at all the technology groups real quick, and then I can move on to consumer discretionary. And I can kind of see what's leading very early. A lot of these discretionary groups starting out the day very strong. Then we got communication services not doing very well. You can see kind of a mixture up here. Industrials, this is an area that's been very hot. We can see transportation services off to a decent start, but we're actually not having a great day so far in the industrials. Same goes with the financials, kind of a mixture. Look at healthcare weak, consumer staples weak. These are the defensive areas. Real estate, not bad. Real estate continuing to move pretty strongly to the upside. And then there's your energy and materials showing some strength. Materials, non-ferrous metals, and then also aluminum. Two groups performing really well early in the action so far today. And then, you could get a quick update because that was right at 9:30. And you can get a sense of maybe some of what's not working. I mentioned toys had a great day yesterday. You can see toys down today. But again, you can just quickly run through and see what's working, what's not working. So I love having it like this. But even better is looking at the chart. So let's go through. I'm going to take you through the three most aggressive groups. And that is technology. Here is your computer services group. This is a chart of the group relative to the S&P 500. So it's computer services versus the S&P. We want groups that are leading. So we want to see groups that are showing big moves up on the right side of this chart. This is a big move down in 2023. Not interested in computer services. How about semiconductors? Yes. This is a group that is leading. Expect some big reports coming out with some of these semi stocks. In fact, the recent weakness, this little bit of pause, could be a great opportunity heading into earnings. The software group, yes, 2023 going straight up. Like semiconductors, been pausing. We've seen some rotation recently, but this is still a very, very strong group. Then we've got electronic equipment starting to make a move for over the last 6 weeks or so, trying to get back through the 20, but it hasn't been one of the best groups. So if I was in that area and that relative chart started to roll back over, I'd be careful. Computer hardware, yes, another big move. Apple, of course, moving above $3 trillion in market cap. We pulled back just below it recently, and you can see that relative weakness just showing up here over the last couple of weeks. But overall, love the move to the upside. Then we've got the electrical components and equipment. Very strong group of late. We had a great move really all the way into the latter part of February. Then we went through 3 months where we were very weak, and now the group's come roaring back. So I think the group is definitely stronger. I'd like to see that breakout above that February high. Telecom equipment, not very good. You can see it was, I don't know if you noticed, but when we pulled up the XLK and all of those industry groups and what was performing well so far today, this was one of the groups that was down. And you can see it's just not one of the best areas. So you might find a stock or two in a group like this that's doing really well, and you can stick with it as long as it's a leader. But just beware that the group is not really helping. There's no tailwinds coming from this group. If anything, maybe some headwinds, and that can make it more difficult for an individual stock. You've got renewable energy, which had been extremely strong into early May, has pulled back quite a bit, but this is an area where we could see renewable energy start to move. And I will mention July, this area of the market does like the month of July, even though it hasn't shown it so far. We'll see whether or not that changes. Next up, we've got discretionary stocks. Hotels starting to strengthen. I know I saw Marriott break out. So there definitely is some strength in this area, and we're continuing to show some improvement. Toys, been under pressure for a long time. With that move yesterday, started to show some nice relative strength, but I'm not sure it's going to continue. We're right up against the key resistance. Got some work to do here. Restaurants. This is a group that was very strong, has pulled back, and now I'd like to see this move back up through these moving averages. If we continue to roll over and turn lower, this is a group that might struggle over the next couple of months. So just beware. Right now, restaurants teetering, maybe showing a little bit of relative bearishness. The specialized consumer services just consistently been going higher. We pulled back in May, but we have been starting to move back up. I like the group. Clothing and accessories, been in a long-term downtrend. If you've noticed, a lot of stocks in this area of the market tend to go on binges to the upside, and then you just can't catch a bid for a while. And then they binge again to the upside, and then you can't catch a bid for a while. Many of these stocks in this group are not good long-term holds. You have to understand that about certain areas of the market. You might have an outlier here or there. I mean, I know Lululemon has been a great long-term performer. It's in this area, but they're not a lot. So just be careful. Still not really seeing much in the way of strength here. Home improvements really starting to strengthen. I noticed Lowe's has been moving up. Home Depot's been starting to strengthen as well. And you can see the group beginning to show some strength. So we'll see if that continues. As long as this remains above that 20-week relative EMA, I'm good with this area. And that's kind of how I feel as stocks or industry groups start to move higher. Let's get them through the 20. And as long as they hold and continue moving up, that's an area you may want to consider. Recreational services. Here's your cruise lines. I mean, has there been a stronger area in the last 3 months? I don't think so. So be prepared. I mean, I think you're going to see some really good things coming from these companies when they report. Royal Caribbean, Carnival, Norwegian. These are all areas of the market, or all stocks within this industry that have been performing really well. Apparel retail, kind of like clothing and accessories. There was that binge on apparel retail for a little while and then right back down to the downside. Over time, it just kind of goes along with the market. But I did see retailers doing much better here recently. Can we get through that 20-day? That's the test there. Specialty retail has been better. We did pull back to that 50, but now we're back up above the 20, which is above the 50. And that's the configuration I like. Travel and tourism breaking out again on a relative basis. Mentioned this one at the opening of the show. Travel and tourism, one of the best groups yesterday. Not only did we move higher, but it actually enabled another relative breakout versus the S&P 500. So travel and tourism looks good. Gambling index starting to turn back up again. I was a little worried about this group below the 20, but it has started to turn back up as well. Home builders, you know, this was one of those things where when the rates were going up, rates started going up heavily and quickly back in the month of May last year. And look at home builders throughout the whole Fed rate hiking cycle. Home builders were going up. Now, if that doesn't tell you a little something about what the market believes about the economy, then I don't know what to tell you, because I like to use these relative strength charts to kind of tell me a story. That's what I use a lot of relative strength for. It's like, what is Wall Street seeing that they're not saying? And believe me, that happens all the time. Wall Street's in this to make money. Those big Wall Street firms are in this to make money. And the way they make money is to make it from you and me. So our goal is to not let them. And one of the ways to not let them is to follow what is actually going on, not what they're saying on CNBC. You know, what is it? Wilson comes from Morgan Stanley, that's been on, keeps talking down the market, keeps saying, you know, he's the chief market strategist. He's been getting it wrong over and over and over again in one of the most high profile positions on Wall Street. And they keep parading him in. And I got to wonder, what is he really doing? I mean, he can't be shorting the market. Could he? He wouldn't have clients for very long. So what's he been doing? Is he really as bearish as he's saying? I don't know. I'm not accusing anyone of anything. I just know the market's going up. And the market isn't driven by you and me. The market is driven by big money, big Wall Street firms, the big wealthy clients of Wall Street firms, the pension funds, all of these things. That's where all the money comes from that drives the stock market. It ain't you and me. They use you and me to get what they want. They manipulate us. They brainwash us. I don't care. Anybody can debate me all they want. I've been following this stuff for 40 years. I'm convinced of it. So the key is not to let them. And that comes in the form of watching the charts, not the lips. Anyway, broadline retail starting to strengthen. Amazon, big part of this. Furnishings, got a double bottom in, turned up. We are back above the 20. So at least a start to maybe something here. This has been a very weak group for a while. Footwear, I'm staying away from this group for the most part. Just hasn't been a very good performer. Nike's been struggling. Crocs, which was one of the leaders for a while. Actually, I haven't looked at that chart in a while, but I know it was struggling. Skechers is probably one of the better ones, but I would be careful with this group overall. The business and training, or business training and employment, starting to strengthen here. I like to see that for obvious reasons. The durable household products starting to strengthen, but this has been a long-term downtrend. This is probably the best it's looked on a relative basis, though, in quite a while. Getting back through and maintaining that move through the 20-day. Automobiles on fire. Yes, this is one of the good groups. I mean, talked about Rivian when it went through 15 or 16. That's now 25, 26. I'm not sure where it finished yesterday. Tesla's been on a roll. Lucid, NIO. I mean, this area of the market has been looking pretty good. Recreational products strengthening, looking much better, above both moving averages. And there is the auto parts group moving back up above the 20-week moving average. So even the poor areas within the consumer discretion area, many of them are starting to strengthen again. And this is that wide participation. Now we move on to communication services. It's the last one I'm going to do for you. Just about 5 or 6 more charts. We'll wrap up here. But broadcasting and entertainment, still very weak. Disney, still very weak. Hold off. There's too many other strong areas of the market to try to catch a bottom. It hasn't worked for a long time. Let's wait. Let's wait for relative strength here. Media agencies, big day yesterday. Nice little breakout here, moving to more than a 1-year relative high. So media agencies starting to show a little bit of something here. This is a group I'd keep an eye on. Publishing strengthened back above both moving averages, still well off the lows we saw last summer. This is an okay group that's starting to strengthen again. Internet, yep, love them. Have they been pulling back for the last 6 weeks? Yes, great opportunity as far as I'm concerned. This is what I'm talking about. When you start to see rotation, the relative strength was apparent in internet up until mid-May. Since then, we've seen that group, it's kind of going off the radar. You'll hear people saying, I don't know what's wrong with internet. It's just not performing well. Everything else is going up. Again, lacking perspective. Look at the chart. We've been going up on a relative basis since October of last year. This is a very strong move in terms of relative strength. And I would use it to find some of your favorite internet names. Something that's been strong, maybe a relative winner that's pulled back a little bit. That could be a little nugget going into earnings. Some of these companies may explode with their earnings. Fixed line telecommunications, horrible. Stay away. This group's not good. And then we've got the mobile telecommunications. And yeah, this is the last group I have for you. And that also is moving to new lows on a relative basis. Stay away. But I just went through the 3 biggest areas, the 3 most aggressive areas of the market in 10, 15 minutes. And I'm talking my way through it, saying what I like, what I don't like. But the other thing that you can do, and this is really cool if you have this chart list, is take a look on you can edit it here and then go into summary. And what I can do is tell you right now, we are 14 minutes into the trading day, and I'm going to show you what's leading. Banks are number 1 right now in the market. Non-ferrous metals, there's your renewable energy, maybe coming back to life. There you got real estate, and you got asset managers, another financial, real estate. That is the industrial and office REITs. You've actually got gold and the miners doing well today. That's a little unusual when the market's going up. Not a fan of that area because when markets go up, the tendency is for these 2 groups to lag, but not today. Having a pretty good day. There's your gambling. But again, I'm going down. I see renewable energy. Here's semiconductors. So I'm seeing a little bit of strength in some of the technology. There's computer hardware. Look, there's internet showing some relative strength. So anyway, this is a great way. What's not working today? Well, that's pretty easy. Just click on this percentage change group on the top of that column, and healthcare providers not working. Recreational services weak today. Maybe we'll get a pullback, maybe an opportunity there. Toys, as I mentioned. This is the that's the waste services. Yeah, waste and disposal services group. Anyway, you can kind of take, and if you look over here at the number, you can see which sectors. Here's the actual industry group relative to the S&P 500. But you can see, 1, 2, 3 of the top 6 are in consumer discretionary today. So anyway, great way to look at the market. In 15 minutes, going to start this live trading room. So members only, but you can try out, you can just do a 30-day trial, and you can come into the room, check out our service, check out this trading room today. I think it'll be great. In addition to looking for individual stocks, again, I'm going to talk about some of the things that would make me much more nervous about the market. I'm not nervous right now, as you can tell. Short term, I mean, yeah, I was saying, hey, we could pull back 3 or 4%, but I'm not getting out of the market because I think the risk of missing the upside is a lot greater than the risk of pulling back 3 or 4%. And as a result, I stay long. It's the way I trade the market. But anyway, love to have you today at 10 o'clock. Sign up. After signing up, then you can log in. And it should be, once you log in, then you have a link right here to click to come right into the live trading room. So all you do is you sign in, and it's right there. You can't miss it. Anyhow, see you all in about 15, well, actually now 13 minutes. I'll do a quick little rundown on what's going on with the market. Are we holding on to the gains? Yeah, pretty much. We got the NASDAQ up 1.18%. S&P up 0.9%, Dow 0.8%. Seeing a little bit of a pullback from earlier in the small caps. You can see that just pulling back just a little bit. IWM at this point, 191.70. So after the big gap up, we have seen some selling here, but overall market action really good today. I'll be back tomorrow for a recorded version over at Stock Charts. That's a recorded version of Trading Places Live. But in 10 minutes or so, 12 minutes, I'll be right back here with Earnings Beats members. So make sure you sign up. Have a great day, everybody. Happy trading.